Look at this chart for a moment. Notice how price pushes above a previous high, then suddenly collapses with explosive momentum. That reaction separates precise institutional entries from random retail guessing. Yet most traders misunderstand what actually creates that move. They chase the breakout or sell too early, placing themselves directly into the liquidity professional's target. The truth is these reversals are not random. They are engineered through liquidity pools, displacement, and imbalances at specific times during the trading day. By the end of this video, you will understand how to identify pre-8:30 liquidity, read displacement correctly, and execute trades using fair value gaps with institutional timing. Let's get started. You will applying this on the 15-minute time frame because this serves as the bellwether chart. This is the time frame where you will identify the key highs and lows in price. You will also be observing imbalances such as fair value gaps and order blocks. However, in this lesson I will intentionally avoid focusing on order blocks. The reason for that is simple. There are ICT models that function perfectly well without relying on order blocks at all. Clearly, the primary concept I am teaching here is the fair value gap. That is the central focus. The reason for that is because it appears every single day. It is a repeating pattern. And more importantly, it is relatively easy for traders to recognize once they understand the structure. Now I want you to think about how you structure your trading day. Specifically, how you organize and annotate your chart for a classic Forex setup. In this example, we are going to focus on the time leading into 8:30. Once we establish that, I want you to focus on this specific time window. The period between noon and 1 p.m. New York time. That window represents a no-trade period. So at this point, you already have your daily range defined on an intraday basis. Everything is clearly structured and mapped. These levels effectively become your boundaries. Your primary trading window in the morning occurs between 8:30 a.m. and noon. The reason for this is because major news events are typically released starting at 8:30, and these events can continue throughout the morning session until noon. Ideally, the most favorable trading conditions appear closer to 11 o'clock. Because of that, you should always try to position your trade before 11 a.m. If everything aligns correctly, you should already be in the trade and riding that movement into the New York lunch hour at noon. That concept is something I was not originally planning to teach, but it forms part of a complete daily framework for understanding the entire range of index trading. By understanding this structure, if your focus is trading indices, you will have a significantly better probability of achieving consistent results using the information I am presenting. Now at 8:30, what exactly should you be looking for? Before 8:30 arrives, I want you to identify the high here, and also identify the low right here. In other words, prior to 8:30, meaning everything to the left of that time marker on the 15-minute chart, you must locate the most obvious and significant swing high and swing low. A swing high is defined very simply. It is a candle that has a lower high to the left of it, and also a lower high to the right of it. This creates a three-candle formation. It does not matter whether the candles close bullish or bearish. That detail is irrelevant. What matters is that the structure forms a swing high, because above that level, you will typically find buy-side liquidity. These are buy stops placed above the high. Now the swing low functions in the opposite way. Before 8:30, the swing low is the candle that has a higher low on the left and a higher low on the right. Again, this forms a simple three-candle structure. Just like before, the candle direction does not matter. It has absolutely no impact on what we are analyzing here. The reason is simple. Swing points are where liquidity naturally accumulates in the market. Once you have those levels clearly marked on your chart using the 15-minute time frame, you can then drop down to your first lower time frame for execution. That time frame will be the 5-minute chart. Now look back at this old high. Focus on the price action right here. That level represents the highest price at that specific point in the chart. This candle trades into that exact level, and even slightly beyond it, essentially creating the same high. When this happens, something interesting begins to form. If you look more carefully, you will notice that we have relatively equal highs, but these highs are formed through several short-term pushes that gradually move higher. If you see 3 pushes forming upward like that, you are observing what is known as a classic 3 drives pattern. The 3 drives pattern works on every time frame. It is a universal concept in price action. However, When you begin to see three drives pushing into an old high, something important is happening. The third drive does not actually need to break the previous high. The reason is because each new swing high is already pressing into the liquidity resting above those levels. Every time price creates a swing high, bearish traders attempt to sell the market. And when they do that, they typically place their buy stops above the previous highs. As those highs continue forming, those buy stops begin accumulating. This process gradually builds a liquidity pool. Meanwhile, informed investors, what many people refer to as smart money, are already positioning themselves for short opportunities. So what exactly are you looking for in price? When price trades above a previous high, and then falls back below that level, you want to see a very clear displacement. This movement should be aggressive. You do not want to see a slow, lazy drift lower. That type of movement is not sufficient. Instead, you want to see strong momentum. When displacement like this occurs, that is when you begin searching for the fair value gap. Specifically, you measure from this low to this high. If price retraces back into that fair value gap, that is where you can begin looking for a short position. Now there is a very important detail you must understand here. If you do not see multiple higher highs forming, and instead price simply moves upward in one continuous run, then you should expect that high to eventually be taken. It does not need to break it by a large margin. Even a small move above the level is sufficient. Once that happens, you should immediately watch for strong movement to the downside. That strong downward movement is the displacement. It should appear very animated and energetic. When you are observing your chart, the move should look noticeably aggressive. In this example, the move becomes more pronounced because price traded above this previous high. You might initially be focused on this high. But as price approaches the older high, remember the key concept. Before 8:30, you are identifying the swing high. Now notice what happens here. Price trades above that level. But does it immediately break lower with strong momentum? No. Instead, the move downward is extremely weak. It is slow and unimpressive. Does that create a fair value gap? The condition is still incomplete, and then suddenly collapses. The following candle closes, and now what do we see? There it is. That is your fair value gap. That is the short opportunity. At that point, you can target the liquidity resting below that low that you identified earlier before 8:30. This is where sell-side liquidity becomes important, because sell-side liquidity aligns directly with your short position. When you sell short, you eventually need to buy the position back in order to close the trade. Where will those buyers appear? Right here, below this low. That is where the sell stops are resting, and that is where price will naturally be drawn. That's it, traders. Thank you for watching. I hope this breakdown brought you greater clarity and provided practical insight you can apply directly to your trading. Make sure to subscribe and enable notifications so you never miss our latest content. Leave your questions and suggestions in the comments below. Also, let us know which trading topics you would like us to explore next. We truly appreciate your support, and we look forward to seeing you in the next episode.